So the primary reason why I wanted to have this call is, for you guys to identify, like, you guys should understand what are the areas that when you look at a question, what are the first things that should come to your mind, so that it will be easier for you to, solve your examination. Like if you are able to get those thoughts for the first at the first time in your examination, it will help you in solving your examination faster. Okay. So that is the primary goal of this. So let's start off with the first question. Junior received the following income for the tax year 24-25. The property income is 17,250, building society interest is 18,000, and the dividends are 16,000. What is Junior's total income tax liability for the tax year 24-25? So every time you see a question that asks you with different types of income, like property income has been given, building society interest has been given, that comes as a part of your savings income, and then your dividend income. If something you have a question with all three types of income being tested, always remember to classify the incomes correctly. Like most of the students have done this mistake, like have non-savings income separately, savings income separately, then dividend income in a separate manner, dividend income separately. So what happens if you do this is the personal allowance. What is the priority of personal allowance should be given to? Which should be given the first priority while you're deducting your personal allowance? NSI. Absolutely. So here when you're having, and property income is a part of your non-savings income, correct? Guys, can you hear me? Am I clear? Am I audible? Okay. I would want everyone to respond so that we can have a more interactive session and we can identify what are the shortcomings that are we should be careful of. Okay. So when you see a question, always remember with different types of income, like you have property income, building society interest, and dividend income. Classify the incomes, like property income will be part of this. Property income of 17,250. Building interest. Building interest will be a part of what type of interest, what type of income is building interest? Building society interest. Savings income, absolutely right. 18,000. Next, your dividends will be a part of your dividend income. So if you're able to write your answers in this manner, total. Like I am showing this just for your explanation, guys, but you should be able to, mark all of it in this way in the rough sheets that you've provided with. If you're writing a center-based test, or if not, use the scratch pad facility. Everyone is aware of how to use the scratch pad, right? Any guy, everyone uses this when you're writing their home, when you're writing it from home, or do you guys you would go to the center and attempt the test? Okay, center based. Okay. So what happens if you do this is you'll be able to do your calculations correctly. Like less personal allowance, the entire personal allowance should will be first deducted from your non-savings income. That will give you a total income of 4,680. And because after that, whatever income is, savings income will fall in the basic rate band. And because the non-savings income is only 4,680, that means the zero rate band that is available for your savings income for up to 5,000 will also be applicable. And if you do not, classify your incomes in this way, you will be making such mistakes. So for that reason, it is very important that you have your always classify your types of income so that you will get a right answer. Is that clear? Any doubts so far, guys? Shall I move on to the next question? Okay. Now coming to this question, it says Peter is employed by Buffalo PLC. He was provided with a laptop for private use on 6th October 2023. Okay, so this should be, if you highlight this, it will make you ensure that you remember the dates and the duration that should be computed. Next, the market value of the laptop when first provided to an employee for private use was 3,800. And the laptop had a market value of 2,200 when first provided to Peter for private use. Buffalo PLC gave the laptop to Peter on 5th April 2025 and it had a market value of 1,200. What are the total taxable benefits for Peter in respect of laptop for the tax year 24-25? So first question that you should identify is on what value will you be calculating the taxable benefit? And that should it be 3,800 or should it be 2,200? That is just being provided for private use. Which one do you use? Will it be private use based on 3,800 or will it be on 2,200? Anyone? Guys, please answer. Malcolm says 3,800. What about the rest? Are you guys able to understand my question or do you guys feel it is wait? I'm going a bit fast. You can tell me. Okay. So when an asset is given to you for private use, initially it was given to someone else, but later you got it. So because of that, the market value that you use in order to compute your taxable benefit for private use, will it be based on when first made available or when it was first made available to you? What is the value that you should be taking? 3,800. Yes, I can say everyone has answered 3,000. Yes, so 3,800 will be the value on which you'll be calculating 20 percentage for getting your, private use benefit for private use benefit. But after that, the laptop was given to Peter for when it had a market value of 1,200. So it was not only talking about. So over here, what is happening? It is not only talking about private use, but also the gift has been given. Gift has been given, which means when the gift has been given, what is the value that taxable benefit that will arise out of it? It will be higher of the value of the gift at the time of giving it, or or the value of the gift when first made available minus taxable benefits that have been claimed taxable benefits that have been claimed on the asset. So here, yes. So what should you take? You should take 3,800 into 20% because that was used for one full year. And before that, it was also used for from 6th October 2023. So that you'll be an additional 6 months of benefit should also be deducted. And that is how you'll be calculating. So in this, we will not be looking at the answers directly, but we'll try to identify how you solve a question so that you're able to, yeah, the answer is 3040, that is right. But I just want to ensure that you guys are able to identify the pointers that you should be applying when you solve your examination questions. Is that clear? Clear, guys? Any doubts so far on that? All right. So let's move to the next question. And yes, this is a question that most of you guys make a mistake in, like all of you get confused with. Let me tell you something. Mary is an employee of Counter Limited and is paid an annual salary of 75,000. She makes contributions of 5,000 into occupational pension scheme every year. In the tax year, she drove 14,000 business miles in her own car, which she was paid 50 per mile by Counter Limited. So class 1 NICs. When you're calculating class 1 NIC, it will be based on your earnings. That is your annual salary and your business miles. But when you have any business miles, for income taxation, you have a division like classification. Like first 10,000 miles will be at 45 pence and over 10,000 pence will be 25 pence. But for class 1 NIC computation, you do not have the 0.25 pence criteria. It will always be total miles into 0.45. That will be the benefit that can be provided. Is this point clear to you guys? This is a thing that most of the students had made a mistake in while I was evaluating their papers. So it is important that you guys remember this. For class 1 NIC, you do not have the classification of 0.5 and 0.25. It will always be straightforward 0.45 on all the business miles. Is this point clear? And that should be added with this and on the annual salary plus the business miles that you travel. On that, you will be calculating your class 1 NICs. Is this clear? Let's move on to the next question. Okay. Next is Judy is provided with accommodation by her employer, with the employer which the employer purchased 35 years ago at a cost of 74,500. So the cost to the employer is less than 75,000, so no additional benefit. You look at it, you should be able to identify it directly. Next, property has an annual value of 2,600. Okay, 2,600 and a market value of 245,000 when first made available to Judy 8 years ago. Now, Judy pays 250 per month to her employer to live in the property. Now, how much is Judy paying? 250 per month to her employer. The accommodation does not qualify as job related. So because it does not qualify as job related, it will give rise to some taxable benefit. But if you look at it over here, 250 into 12, the amount that Judy is paying comes up to 3,000 pounds, while the property's annual value is only 2,600. If you pay more than the annual value of it, then the taxable benefit will be zero. All right, like most of you guys, what you have done is you've calculated you have identified that 2,600 will be a taxable benefit. But you're getting confused between the point that it is important to know if you pay more than what the value is of the benefit, then the taxable benefit that arises will be zero. Is this point clear, guys? Any doubt on this so far? Am I going too fast? Is this fine? Shall we move on to the next question? Yes, no, maybe. All right. Now, next question you can see here is during the year ended 31st March 2025, Blue Cheese Limited purchased a second-hand machine for 100,000. Okay. The old machine was disposed of during May 2024 for 10,000. The old machine originally cost 90,000 and super deduction was claimed when it was purchased. Okay. On 1st April 2024, Blue Cheese had a tax return on value brought forward on the main pool of 43,000. All right. What is the maximum capital allowances that Blue Cheese Limited could claim? So here there are three things. One is second-hand machinery purchase. On that, do you get AIA on that? Yes or no? What allowance will you claim on the second-hand machinery, guys? AIA. So there you get your 100,000 completely. That is your capital allowance. Plus, always remember when a super deduction on any machinery disposed was claimed, then all the disposal proceeds that are received will be your tax charge. So they should be deducted from your capital allowances. This is a very important point to remember. Like always remember this. If any, claim was made, super deduction was claimed on an asset, then at the time of disposal, the whatever the proceeds received will be acting as a tax charge and they should be deducted from the total capital allowances. Okay. And they will directly go to the capital allowances column and they will not be a part of the deduction, should not be a part of, or the disposal proceeds should not be a part of the main pool column or the special rate pool columns. Next, we have had a tax return on value brought forward on the main pool of 43,000. So 43,000 is there. So what do? You directly take 43,000 into what is the rate for this main pool brought forward? Main pool, what is the rate? 18%. Absolutely right. That's exactly what you should be doing. And this will be a total calculation. Is this clear, guys? So far, so good. So if you're able to identify pointers like these, it will help you, if complete your section A's and B's faster so that you have sufficient time to attempt your section C. All right, is that clear? Let's move on to the next question. Next, if Dove Limited has one associated company and has the following results for the 9-month period 31st March 2025. Okay, Dove Limited, it is an incorporated company and the dividends of has trading profits of 40,000, chargeable gains of 20,000, dividends of 12,000. The dividends of 12,000 were received from Pro Limited. Okay, so there are two things to remember. One is because there is an associated company, your upper limit and lower limit thresholds, upper limit and lower limits would be adjusted. Okay, that is one point to remember. So because of that, what will happen? What is your upper limit? Normal upper limit. If you are unable to remember, that's not an issue at all. We always have them in our table provided to us. You have it clearly here. The upper limit is 250,000, lower limit is 50,000. So because the upper limit is 250,000, what will happen? Because there's an associate company. So this will be reduced by 2. And same thing for lower limit as well. Lower limit would also be 50,000 divided by 2. But you have to remember one more thing that you should consider over here is the following results were only for a 9-month period. And these limit thresholds are for the entire year. And because of that, these thresholds should also be adjusted for the months. So this should be 9 by 12 and this will be 9 by 12. Because of that, your limits will now be, modified. So it will be 8,000 divided by 2 into 9 by 12. Now your upper limit would be 93,750 and lower limit would be 50,000 divided by 2 into 9 by 12. 18,750. Is this point clear to you guys? So because of this adjustment, now what will happen? Your total taxable trading profits will be 60,000 because dividends. The other point that you should be remembering over here is dividends are completely exempted from corporation tax. Whenever you find any question, even in section C, asking you for dividends, your value in the examination should be, you should write dividends, and beside that you should just place a zero. If you place a zero, it will be very clear. When you place, you will be getting a zero point 0.5 mark straightforward, because for zeros as well, 0.5s will be included, and it is important that you mention them. Clear on this so far? Now, because our income is lying between 18,750 and 93,750, we will have a marginal relief that should be claimed. So that is exactly how we will be calculating your taxable corporation tax payable on Dove Limited. Understood so far? Everything clear so far? Any doubts? Guys, always remember these points. If you're able to identify them at the first go, like if you're able to identify what is happening because of whatever points are given in the question, it will make your life as easy as possible. Like your calculations would just be going like a cakewalk once you're able to identify what is it they're asking for and what are the factors that are affecting the question that they're asking. Like here they've asked corporation tax. No, it'll, you can see the tax in, income is 60,000. So 60,000 will be taxed at 25%. And from that, you should be deducting a marginal relief. How do you calculate a marginal relief? Upper limit minus augmented profits into standard fraction, that is 3 by 200 into taxable total profits of 60,000 divided by 72,000. Is that clear? Yes. So you will be calculating it first at 25%, then a marginal relief should be deducted. Any doubt on that so far? Should I go on to the next question? Your augmented profits would only be 60,000 because it is an associated company. So technically augmented yes. So when you're calculating augmented profits, it only means your trading profits, your taxable total profits, plus dividends from non-associated companies and not the associated companies. All right, is that clear, guys? Any doubts on that so far? Yeah, it will become one only. Correct, Riya. That is right. Okay. What is the answer that you're getting when you calculate it? Can you just show me your calculation so we can discuss where did you go wrong probably? $15,000 will be your. Okay, that is all right. It's 3 by 2. Okay, clear, right? So if you're not sure of that, what you can do is upper limit 93,750 minus and minus your augmented profits of 16,000 into 3 by 200 into 60,000 divided by 60,000. So that is 1, like you have mentioned earlier. That is all right. That's not an issue. But Clear so far? The points are clear, right? Okay. Any doubts until here, guys? I think Avantika has also joined us. Hi, Avantika. So shall I move on to the next question? Okay. So when we come to this question, Sheila is registered for VAT for the quarter ended 31st March 2025. The input VAT incurred on her purchases and expenses included the following. Entertaining overseas customers is 620, purchases of new office equipment is 1550, and purchase of new cars for business and private use by one of Sheila's employees. What is the amount of input VAT recoverable by Sheila in the quarter ended in respect of entertaining office equipment and car? Entertaining overseas customers. Is it an allowable expense? And why is it an allowable expense? I'm talking about the entertaining overseas customers here. First, entertaining overseas customers. Is it an allowable expense or not? Yes. And now let's take entertaining UK customers. Is it allowed then? Exactly. That is the right answer. So because of that, it will be only overseas customers will be allowed, and purchase of new office equipment will be allowed. But purchase of a new car for business and private use by one of Sheila's employees will not be an allowable expense when you're calculating your VAT. All right, it is only these both. This 50% will also not be allowable. Yes, exactly. Only if it is wholly business, that is when it can be allowed. But because there is a private use over here, it will not be allowable. Did I say allowed or something like that? Did I go wrong? Yes, did I mention that it would be an allowable expense? If yes, my bad, sorry. It is a non-allowed expense. Okay, now let's move on to the next question. Destiny is registered for VAT and calculates her VAT liability based on the flat rate scheme. The relevant flat rate percentage for Destiny's business is 12%. Flat rate percentage has been given as 12%. Now, for the year ended 31st March 2025, Destiny's sales exclusive of VAT were standard rated sales were 45,000, zero rated sales were 25,000, and exempt sales were 8,000. When a flat rate percentage is being used, and what is the amount payable by Destiny to HMRC in respect of the year ended 31st March 2025? And they're asking about the VAT payable. Always remember, your total turnover should include standard rated sales inclusive of VAT plus zero rated sales plus exempt sales. Whatever is the turnover that you get, on that you should be applying 12%. That means it will be 45,000 into 1.2 plus, because you've told it is exclusive of VAT. So you will have to add the in VAT proportion to it. So it will be 1.2 plus 25,000 plus 8,000 into 12 percentage. Input VAT, you will usually they'll only be asked, your VAT liability will be straight off on your turnover. You will not have any input liability. Though you'll have to record your input VAT liability, but when you're claiming to the HMRC, it will only be the inclusive rate that you will be taking. So input VAT will not be deductible from this. Is that clear? Yes. So though you will have to make a claim with with HMRC about your input VAT net and VAT, output VAT and input VAT, considering the 20 percentage. But when you're finally making the payment to HMRC, that will be at the total turnover, including inclusive of VAT, into the flat rate scheme. Is that clear, guys? Yes. So let's move on to the next question. For here, Richard acquired a holiday villa for 125,000 on 1st May 2014. He gave it to his wife Rose on 30th September 2019 when it was worth 100,000. Is this relevant to us? It was given to Rose, like his wife is Rose, and it was given to Rose on 30th September 2019. So will it be relevant to us? Yes, the cost should be taken as 125,000. And next, exactly, spousal wife transfer would be at 125. No, would be at no gain, no gain, no loss. So it will be at 125,000. The villa was never the couple's main home. Rose had no other capital disposals in the tax year 24-25 and had capital losses brought forward of £11,000. The taxable income for the tax year 24-25 is 30,000. So because of this, what are the what are the benefits that Rose has when she wants to when she disposes it off? First, the gain will be 175,000 minus 125,000. Is that correct? Is that the correct calculation? Yeah, exactly. So from that, you will be deducting your, what the capital losses that have been brought forward, which will be deducted, and then your tax, capital gains that you will have will be what will be it? 150 minus 11,000. 39,000 minus your annual exempt amount that you have for 3,000. That will give you your 36,000 of taxable gain that has been calculated. But here they are asking for capital gains tax payable. So since taxable income is 30,000, how much of it will be taxed at 18% and how much will be at 24%? As per residential property. That is right. So 7,700 will be taxed at 18%. Exactly. That is absolutely right. And that is how you will be calculating this question. And the rest will be at 24%. Because it was never their main home, what will happen? They will not be eligible for residential rate, residential relief that will be available. Private residential relief will not be available to them. Is this clear? Any doubts on that so far? So no, because if it was their main home, then they could have had an exemption of relief to be claimed. But now because it is not their main home, they cannot have any reliefs claimed on this, and instead it will be a straight up capital tax that will be charged on it. Now, this is again the most important question. Like most of you guys have gone wrong in solving this question, especially in calculating the cost of the asset. So it is important to look at this question clearly. Now we see Brandon bought 30 hectares of land on 1st March 2017 for 300,000. Okay. On 1st March 2019, he sold 10 hectares of land for 150,000. At this time, the remaining land was worth 250,000. Okay. So that means there's a part disposal that is happening here. On 1st Jan 2025, Brandon sold the remaining hectares for 425,600. So here it has been given that, so your sale proceeds are straightforward. Sales proceeds are 425,600. But how do you calculate your cost? Cost would be is equal to 300,000 into 150,000 divided by 150,000 plus 250,000 will give you your cost of the land sold, cost of the land sold. And from that, and from 300,000, the cost of land sold will give you the cost of the remaining 20 hectares, the remaining 20 hectares, which will be used for your cost, which will be used as cost for your capital gains. Is this point clear? Clear until here? Any doubts so far? Or do you want me to show the calculation as well? Let me open up. I have 300,000 into 125,000 divided by 125 plus 250 would be 400,000. 93,750 minus your initial cost of 300,000. Would be giving you your 206,250 plus 425,600. Did I go wrong somewhere? I think the calculation must be wrong. Yeah, the scientific calculator was the mistake over there. That was the issue. Use a standard calculator, guys. That will really help you in getting your calculations right. Especially for, tax, you do not need to use a scientific calculator. And, the standard calculator will just do the work for you. All right. And what will be the due date for the capital gain? What will be the due date for the capital gains? Because the asset is sold on 1st January 2025. So it will be a part of which tax year? 31st Jan 2026. Okay, anyone else? I can only see Avantika answering. What about the rest? Okay, why will it be 31st January 2026? And why not within 60 days? And for what is the chargeable gain? When is the due date for 60 days? When is the due date of 60 days for which type of assets? Is the due date 60 days? Yes. For residential property, you will have to file it within 60 days, Avantika. But because it is land and not residential property, that's why it will be 31st January 2026. That's what I was trying to ask you. I wanted to ask for residential property, what would be the due date for? All right. Yes, and you should be very careful when answering questions like that because those will be something that will be tested as a part of your examination. Okay, let's move on to the next question. Bruce died on 16 July 2024. He made one lifetime gift on 10 November 2019 into a discretionary trust. He paid lifetime tax of 52,250 and the gross chargeable transfer value of the gift was 586,250. How much inheritance tax is due on the lifetime gift as a result of Bryce's death? This is again a very straightforward question. Like you have your gift value 586,250 minus your nil rate band 325,000, and on that you will be taxing it at into 40%. And because he has died within 7 years of time, so there will be some taper relief available. That taper relief should be deducted. Taper relief should be deducted minus taper relief being deducted, and also the most important point to remember over here is 52,250. You should be deducting 52,250 should be deducted in order to get your life IHT due at the time of death. Yes, that is right. Taper relief is at 40%. Yes. So is that clear? Because most of you guys do the calculation right, but they forget to add, deduct the lifetime tax that is, that is deductible. So that is the only point that you should keep in mind. All right, clear until here. Let's move to the next question. Any doubts? All right. Brian died on 11th December 2024. Yes, when car is leased, you will be getting it. But here it was not leased over here. So because of that, you will not be getting that because private use is there. Is that clear? Sorry, I missed that question earlier because over here the car was purchased. Okay. Yes, let's move on to the next question. Brian died on 11 December 2024 and left an estate worth 1,276,000 to his daughter. Brian's main residence valued at 300,000 was included in the total value of the estate. Brian made a transfer to his sister on 18 June 2019 worth 220,000. How much inheritance tax is payable on Brian's death estate? When a question of inheritance tax is used, there are two things that you should remember. One is sometimes they will tell assume that all exemptions have been deducted. All exemptions have been deducted from the gift. If they give this point, all exemptions are deducted. If they give this point, it means the gift value that has been provided is net of annual exemption amount and any gift exemptions that are applicable on marriage and all of that. But here, nothing like that has been given. So that means the value of this gift would be 200,000 minus 3,000 minus 3,000. That will be the value of the gift. And because of this, always look for it. Every time in inheritance tax, if it is not given, then you should be deducting the annual exemption amounts. But if it says, net of all the exemptions, then the gift value itself should be taken. So because of that, the gift value is now 214,000, which will be using up the nil rate band. So it will be nil rate band available on death would be 25,000 minus 214,000. Is that clear, guys? This is the only point that you should be remembering over here. After that, it is a straightforward calculation. If you miss out on this 6,000, your answer that you get will be going wrong. All right. Always, in any irrespective of the question, always and always you will be getting a pointer saying that gift is net of all exemptions or nothing, no mention of it. If nothing has been mentioned, that means you will have to deduct the exemptions. Clear? Do you want me to move on to the next question? What about the rest? Are you guys following me? Are you guys able to understand that so far what have we done? Any doubts until here? Any doubts so far, guys? Or everything is clear? Are you guys noting down all the pointers that you should be remembering when you attempt questions? Because trust me, these are the pointers that I have used in my examination as well, like to identify what is going wrong and to what is going wrong, and especially during my mocks, whenever I made a mistake, these are the pointers that I try to identify them so that I do not repeat them during my final examination. So I'd want you guys also to do it. Do you think exam will be similar to these questions? That is again a tricky question. Like the difficulty level might be similar to this, but how the questions are, what the questioning patterns are, might be changing. Like you will be able to, they will not, you majorly will be able to identify the questions directly straightforward, because in taxation, there's nothing like they'll twist the questions. It should be given straightforward because otherwise you will not be able to perform your calculation. So for that reason, the questions will be of the same level, yes. So yeah. So all these questions will be part of Kaplan, they'll be part of BPP, they'll be on your study hub as well, because all of these questions have been coming for long time, long time. Even since when I have been writing this exam, we had similar questions as well, except that tax rates and all have changed. But other than that, the questions were almost of the similar level. So even if you solve your kit, that's why I always keep telling it is important to solve your kit and be thorough with how the questioning pattern is, because that will really help you understand how to look at a question and how to solve that question. Is that clear? Because your section A and section B, it is pretty straightforward. It is either a yes or no answer. Like there is no, like if you write something, you will not be getting step marks. You'll be getting entire 2 marks or it will be 0 marks. So for that reason, if your answers are very clear and accurate, you will be getting your marks for sure. So for to be that clear in your examination is why we are discussing all these important pointers. All right, let's move to the next question. Guys, I want you to look at the number of theory questions that are there over here. Like theory questions, as in all the self-assessment and everything. They are almost, testing you just for theory for at least 14 marks, if I'm not wrong. But 14 marks is just theory. So it is important you guys, stay focused on ensuring that revise and revise. That's the only thing that you can do when it comes to the self-assessment part of it. Every day, take up 1 to 2 hours, try to compare the differences, income tax, corporation tax. Put them side by side. What are the dates here? What are the dates here? Try to identify them. Once you're able to identify the differences, trust me, you will be able to remember them for as long as possible. All right. Let's move to the next question. Okay, so let's see the question over here. Sorry, I'm start on this. Which of the following statements concerning self-assessment tax returns for individuals is true? Individuals with tax payable less than 1,000 for a tax year are not required to file a tax return. This is complete false, because this is only applicable to payment on account. If you're having less than 1,000 as your tax payables, then payment on account is not necessary. That's all this is. But it does not say that with tax less than 1,000 are not required to file a tax return. Next, individuals are only required to file a tax return if they receive a notice to deliver from HMRC. Again, not true. Why? Because if that is the last date that you can have to file your returns by, but other than that, you will have to file your returns by the due date. Always for theory questions, if you're doubtful, try to eliminate the wrong answers, and then you'll have your right answer there with you. Next, all individuals who submit a tax return on time or are able to have their tax payable calculated by HMRC. This is right, but let's also look at why the fourth option cannot be right, so that you're definitely sure that C is your right answer. Next, the tax return for an individual covers income tax, class 1 and class 4 NIC contributions, and capital gains tax liabilities. Why is this wrong? Avantika, it will cover class 4, but class 1 will not be covered. Class 1 will be covered as a part of payee and not as a part of your individual tax returns. Yes. So it covers income tax, it covers class 4 NICs and capital gains tax liabilities. But because class 1 has also been mentioned, that is why this answer is wrong. All right, clear, guys? Any doubts until here? All right, let's move to the next. Yes, Avantika, class one will be done within payment on account, but that means that's not exact because payment on account, when do you do your payment on accounts? What are the dates? Yes. Dates and reason. Payment on account, you don't need to tell me the date. Tell me the reason why you file it as payment on account. And on what basis do you calculate your payment on account liabilities? Is payment on account calculated based on your previous year's tax return liability? Is that correct? Yeah. Let's move to the next question. Again, theory. See, 4 marks over here, and we have seen one question already in the previous one where they were asking about the date for capital gains tax payable. So 6 marks are literally coming from your your dates over. Hence, we are still in section A over here. So for tax year 23-24, Kai filed a paper self-assessment tax return on 10th August 2024. What is the deadline for Kai to make an amendment to his tax return for the tax year 23-24? And by what date will HMRC have to notify Kai if they intend to carry out a compliance check into this return? First, tell me what compliance check is, and then we'll discuss about the answer. What is a compliance check? Anyone? What is a compliance check? Yes, checking backup proofs for calculation. So basically, it is like if you have actually paid the correct filed for correct amount of returns or not, is what a compliance check is. And for that, they'll be evaluating all of your calculations and everything. That is what compliance check is. So by when will HMRC have to note intend to carry out a compliance check into this return? What are the correct answers? First, amendment. Always remember, amendment should be made within 1 year following the filing date. And our filing date, since we are talking about 23-24, so that is 6th April 2023 to 5th April 2024. So the actual filing date would be 31st January 2025. And because of that, the amendment should be made within 1 year. So within 1 year, that is of the 31st Jan date, that is 31st Jan 2026. And coming to the compliance check can be carried out will be 1 year from the date when you have filed your taxes. So first 31st Jan 2026, because of that our answer is restricted to either B or D. But now the compliance check will be within 1 year from the actual filing date. The actual filing date is 10th August 24. So 1 year from that would mean 10th August 2025. And with that, you get your answer of B. All right. These questions are again very tricky because first you should be able to identify, even if your one answer might be right, but if your second answer of compliance check is wrong, then your answer goes for a toss. So for that reason, it is very important that you focus and have sufficient, confidence about everything that you are revised with your self-assessment as much as possible. They might be tested everywhere and anywhere. I think this time in the pre-September mock that I have seen, this is the first time that they have actually not asked any payments required and all of that. So that way, it is a lucky thing for you guys, and they have mostly tested your, compliance self-assessment in your section A's and B's. Okay, let's move to the next question. Over here, Gilbert's income tax liability for the tax year 23-24 and 24-25 are as follows. Income tax payable 300, 320, 24-25 is 2,400, 1260. CGT is 240 here and 0 over here. What payment on account will Gilbert have to make on 31st July 2025 in respect of his tax liability for the tax year 24-25? So here they're asking about a payment on account that is to be made. I have told this point earlier also. Here, payment on account will not have to be made if your tax liability is less than £1,000. Because it is less than £1,000. Your previous year's tax, total previous year's tax is only £860. So because of that, it will be zero. But over here, when you're considering payment on account, it will only be based on income tax payable and your capital, class for NICs, and not your capital gain tax liability. Always remember this. Because this total is 620 and less than 1000, our answer would be zero. All right. With this, we come to an end of section A. Do you guys want to take like a 5-minute break or 10-minute break and come back? Yes, CGT is for balancing payment. That will be made on 31st January 2026 for 24-25 tax year. Do you guys want like a 5-minute break and get back after that to discuss section B and C? Yeah, is everyone back? What about Malcolm? Yeah, I can see was also back. Ria, are you back as well? So let's start with the next question. Now we move on to the first question of section B, where we're discussing Thomas died on 11 January 2025. Before his death, Thomas made two gifts during his lifetime. On 12th April 2017, he gave a gift to his niece for her marriage worth 9,000. Okay. So since it has been mentioned as marriage, you will have something that do with your marriage allowances, marriage exemptions that are available. He also made a transfer to a trust on 2nd September 2017 worth 400,000 and paid lifetime tax on it. Lifetime tax on it. Okay. His wife Sarah died in June 2008. Her unused nil rate band was 62,400 and was therefore available to be claimed by Thomas's personal representatives after his death. Okay. At death, Thomas's estate was worth 1.6 million. This comprised of cash worth 500,000, ISAs worth 50,000, premium bonds worth 250,000, a house worth 300,000 with a mortgage of 60,000, and shares worth 300,000 and chattels. As a reminder, the whole estate was left to his son. Because the whole estate was left to his son and there is a main resident house available, so residential nil rate band would also be available. Okay. So these are the things that you should be considering. Next, we have nil rate band for the tax year 2008 to 9 is 312,000. That means when Sarah died, her nil rate band available was 62,400 out of the 312,000 that was the nil rate band at that point of time. That is what you should be remembering here. Which of the following statements is true concerning inheritance tax exemptions for lifetime transfers? If potentially exempt transfers and chargeable transfers are made within the same tax year, annual exemption will always be applied to CLTs. This is because unlike CLTs, PETs may never become chargeable. That is never the case. Always it will be on first come first serve basis. Whichever gift is made first, that will be having exemptions deducted from that. Is that clear? Clear on that point, guys? Any doubts on that point so far? Okay. So let me tell you something. So here, what is the point that has been mentioned? If potentially exempt transfers and chargeable lifetime transfers are made within same tax year. So say for suppose you have made 1st August 2017 first gifted to daughter. Gifted to daughter. Now what is this? Is it a potentially exempt transfer? Yes. So let's take the cost is 60,000. Next, 1st September 2017 gifted to trust. Gifted to trust. Is this a CLT? Yes or no? Yes. So this is 50,000. Now what this point says, if potentially exempt transfers and chargeable transfers are made within tax year, so both of them are made within the tax year, yes, the annual exemption amount will always be applied to CLTs. This is because unlike CLTs, PETs may never become chargeable. Is that what will happen? No. Always remember whichever gift was given first. So from that, your annual exemption of 6,000 will be deducted. Your 3,000 for 2 years. So let's take it like 6,000. Then for the gifted to trust, there will be no CLTs available. There will be no annual exemption available. Is this point clear now? So because of that, this is not an option for us. Okay, next. Small gift exemption applies to transfers to both individuals and trust. Is that true? No, individuals only. Absolutely right. Next is a gift in consideration of a marriage from an individual's parent's sibling is exempt up to an amount of £1,000. So if it says individual's parents, how much is the amount that is exempted? Others 1,000, absolutely right. But if it says individual parents, right. If it is from grandparents, if it is from yes. And what about spouse to bride or bride to spouse? 2,500. So 1,000 is not the answer. 2,500. Spouse to bride or bride to spouse is 2,500. And from anyone else, it is £1,000. That's all right. So, and next, transfer of individual savings are transfers of ISAs and premium bonds are exempt transfers for IHT purposes. For IHT purposes, none of these assets are exempted. They are chargeable. They will be part of your death estate. And because of that, even this option is wrong. And with that, we come to the third option. Always in theory, if you are doubtful between one or two options, try to do the elimination method, then that will definitely give you an answer. All right? It will definitely help you very much. Clear until this point? Any doubts so far? What is the total amount of IHT exemptions that can be deducted from the transfer from Thomas to his niece on 12th April 2017? Okay, so what happened? He has made two gifts in his life. 12th April 2017, he made a gift to his niece for her marriage worth 9,000. So gift was worth 9,000. Now they're asking what is the total amount of exemptions that can be deducted. So what are the exemptions? One would be AEA, two times, correct? Then the other is it is to niece. So what will be the gift total, total exempted amount we have discussed earlier? It is 1,000. So that will bring it up to a total of 7,000. Always remember to identify what they're asking. Total amount of IHT exemptions is what they're asking for. Not what is the amount, what will be the remaining amount that will be taxed at. All right, clear until this point? Any doubts so far? Guys, you can tell if I'm going too fast or too slow, you can tell me so we can, move forward, move ahead. Is that clear? This is a very straightforward. This, I think, out of all the questions that you've seen so far, this is the most straightforward question that you can ever see. How much lifetime IHT was payable on the gifted to trust on 2nd September 2017? Gift was made worth 4,000 and paid lifetime tax on it. So it is a very straightforward question. So for a minor, you have to deduct the nil rate band. And after that, on that, how much will you be taxing? He paid the lifetime tax on it. What will be the percentage that you'll be taking? Correct. And that's it. Because he has paid it, so you will have to calculate it at 25% and you're good to go. That is all you will have to do with this question. All right. Now, next question. What is the total nil rate band available when calculating IHT on Thomas's death estate? So here, what is the nil rate band that would be available? Normally, it is 325,000. But here, he is also getting his spouse's unused nil rate band. His spouse's unused nil rate band was 62,400 out of 312,000. So do we directly take 62,400 here? No. What should we be doing? It will be nothing but percentage of unused. Exactly. It will be 62,400 divided by 312,000 will be giving you 20%. So because it is 20%, that should be applied to 325,000 into 2,500. That will give you 65,000, additional 65,000. So it will be 325,000 plus 65,000 is how you'll be calculating it. And yes, you get 390,000. Now here, if they simply change one word from this, from total, if they simply ask, what is the additional nil rate band available when calculating the IHT on Thomas's death estate? Then the answer would be 65,000. Got it? Always look for the keywords. If you miss out on one keyword, your entire answer goes wrong. Like if you read the question once, you're confident. Try to read it again and give that assurance to yourself that you're doing it right. And then move forward to the next question, and it will really change your life. You will make very less mistakes, as less mistakes as possible. Is that clear? Yes. Now let's move on to the next question. What is the total available residency nil rate band when calculating the IHT on Thomas's death estate if the relevant election is made? Here, if they say there's a possibility to make a relevant election, what is the relevant election that can be made? You can see spouses died, and because of that, they were living in, they had a main residence. So that means the nil rate band, residential nil rate band could be transferred from spouse as well. So it can be transferred from spouse. So it will be 175,000 plus your unused would be 175,000, which gives you a total of 350,000. But what is the value of the residential area of the house? Let's make it this way. It is 300,000 and with a mortgage of 60,000 on it. So what is the value of the house? It is only 240,000. That means R and RB will be lower of available residential nil rate band and your property's value. Yes, it will be lower of the both of those. That is exactly why the value of the residential nil rate band will only be 240,000. All right. Yes, that's exactly what we've calculated. It will be lower of RNRB available and your property's value. Is this one clear, guys? With this, we have finished the first question of section B as well. So let's move on to the second question. Any doubts until here? What about the rest? Any doubts so far? Everything is clear? Okay. Let's move on to the next question. Next, what is the net? Okay, so let's start with the question first. William made the following disposals of assets during the tax year 24-25. And on 30th June 2024, William sold a business that he had run as a sole trader since 1st January 2020. He realized the following gains and losses on the chargeable assets and business. Goodwill was £60,000. Freehold property was £64,000. Storage unit was had a loss of £13,000. The goodwill has been built up since 1st January 2020. The freehold property has been acquired 6 months prior to the date of disposal, and storage unit had been acquired on 1st June 2021. All right. So coming to the second part of the question. On 3rd August 2024, William sold 2 hectares of land for 92,000. William's father had originally purchased 3 hectares of land for 19,500. Okay. His father died on 17 June 2019, and the land was inherited by William. On that date, 3 hectares of land were valued at 28,600. So now, what would be the cost over here? Will it be 19,500 or 28,600? The normal cost of the entire value, not the cost that is allocated to the sold part. What will be the deemed cost that we'll be considering? Will it be 28,600 or will it be 19,500? 28,600. That is absolutely right. Because it was transferred to his son. Instead, if it says he is transferred it to his spouse on that date, it is transferred to the spouse, then the value would still be at 19,500. Is that clear, guys? Are you with me so far? Yes. Try to do such comparisons. It will help you remember things much better. Like look at a question, you're able to identify how you calculate it. But then if what you can do is in your next 3 days, what you can do is okay, if it is this, it is this value. If it is because it is son, the value is 28,600. But what if it says it's his spouse has passed away or something like that? Then it will be 19,500. Try to relate the concepts from every nook and corner. It will help you remember all the benefits, all the exemptions and everything as better as possible. All right? With me so far? Are these tricks helping you guys or do you feel this is wasting your time from your preparation? You can tell me very honestly because this is your important last 3 days. So I wouldn't want to waste your time. If this is not helping, we can end the call as well. The others, okay, this one. All right. Mm, Next is on 1st December 2019, William incurred legal fees of 500 defending his title to 3 hectares of land. The market value of the unsold hectare of land as of 3rd August 2024 was 38,000. Okay. So what had happened, he has sold 2 hectares out of 3 for 92,000 and 1 hectare was left at 38,000. So same thing what we have done earlier, part disposal. It will be the cost should be allocated to the part that is disposed and to the undisposed part of it. Next, on 12th October 2024, Williams sold a house for 840,000, which he had owned individually. The house had been purchased on 12th December 2009 for 22,900. House was always used exclusively for, or sorry, occupied the house as a main residence. 1/4 of the house was always used exclusively for the business purposes by the couple. Okay. So 3/4 was main residence and 1/4 was business usage. All right. Tax year 24-25, William is a higher rate taxpayer. For the tax year 24-25, Jane had a taxable income of 21,440 and made chargeable gains of 3,000 on other residential property disposals. Okay. Next, William's brother Luke made the following disposals. On 1st October 2013, Luke sold a factory for 230,574 and realized a gain of 31,083 pounds. In May 2014, he bought a warehouse for 231,211 and then sold the warehouse in 2024 for 270,313. Both the buildings were used for the purpose of Luke's sole trader business. Okay, so instead of first he has sold a factory, then instead of a factory, he has purchased a warehouse. That is what is happening over here. Now let's see the first question. What is a net chargeable gain on the disposals of Williams sole trader business on 30th June 2024 that qualifies for business asset disposal relief? So what are the conditions to be satisfied to get business asset disposal relief? One is it should not be an incorporated business, correct? Is that one of the conditions? Yes, no? Substantial sale of business. Okay, the other point, how much period of ownership should be there before it has been disposed? 3 years of holding. Correct. So here he has decided to sell the business on 30th June 2024 and it had been running from 1st January 2020. So does that satisfy the condition? Yes, no, maybe? Yes. So are these points relevant? Because the goodwill has been from 1st of January 2020. Freehold property was only 6 months before to the date, and storage unit was from 1st June 2021. Are these points relevant to us? If the business qualifies as business asset disposal relief, then the dates of when the assets were purchased is irrelevant to us. So the total chargeable gain, that is, qualifying for business asset disposal relief, would be 60,000 plus 64,000 minus 113,000 minus 13,000. That will give you your 111,000. Yes, that's absolutely right. Clear until here? So guys, these are the tricky parts. Sometimes they might give you these. So what will you do? You'll think that, okay, because it is for the asset to be held for 3 years period. And because of that, you'll only be considering 60,000 minus 63,000 and you'll be doing your calculations. But luckily we do not have it as a part of our options. So that way you will not be using that. But just to be clear, be thorough with your concepts, your fundamentals. If you know what all qualify for BADR, what are the conditions for it, you go into the exam straightforward, you'll be able to look at the options and you'll be able to select the right answer. All right. And you'll be able to cut out everything that is unimportant to us. Like we have done it at this point. Like this is so unimportant that if you eliminate it also, there is nothing that will affect your exam, testing at all. So that way, let's move on to the next question. What is the allowable cost used in the capital gains disposal computation for the sale of 2 hectares of land on 3rd August 2024? Again, it will be part disposal. So how do you calculate it? How much do you calculate the cost on? It will be 28,600. Because Williams is disposing it, the cost will be 28,600, correct? Into market value of the asset, market value of the sold part of it, correct? 92,000 divided by 92,000 plus 38,000 plus how much is it? 38,000, yes. But there is one more thing that you should be considering. Until this part, you will be able to calculate the cost correctly. This cost correctly included. But next, the point that you miss out on would be the part where it says a legal fees was incurred of 500 defending the title to the 3 hectares of land. So legal fees is also a deductible expense for capital gain computation. So it will be 500 into 92,000 divided by 92,000 plus 38,000 is how you will get your total cost. With this, you get total cost that should be deducted from cost that from the sales proceeds. Is this point clear until here? Do not forget about the legal costs. Legal costs are allowable costs because they are costs incurred for selling for the asset itself. So for that reason, legal costs are an allowable expenditure. Let's go to the next question. What is the amount of private residence relief available on the disposal of house by Williams? Again, as straightforward as it can be. Private residence relief, on what will it be available? Will it be available on the cost or will it be available on the gain? On the gain. Now we can see the house has been purchased for 222,900, but they sold it for 840,000. So it will be 840,000 minus 222,900 will give you your gain. Now private residence relief. How much will the private residence relief be available to over here? Since 1/4 of the house was always used exclusively for business purposes, private residence relief will be available for 3/4. All right. 840,000 minus 229,000. Think I'm an 222,900 will give you your answer. That's exactly what you should be doing. Clear until here? Any doubts? Do you want me to calculate it for you, or are you clear with this? Whatever period. And here you can say that they have always occupied throughout the period of ownership, they have stayed in that house. So you do not have to calculate the durations when it was exempted, when it was necessary, and all of that. So is that very clear? Any doubts until this point? All right. Now let's move to the next question. Again, here, whenever, again, let me tell you guys something. Whenever they say select two of the following or three of the following, I've seen most of you guys are right with one, but the next point is something you go wrong with. So because of that, also you lose your marks. So it is very important if always try to use the elimination method in order to remove the wrong options. You will be good to go on that. William's brother Luke has told William it would have been better to have transferred 50% ownership of the house to Jane prior to its disposal. Which two of the following statements are correct? Transfer to Jane would have been at no nil gain or nil loss. Is this a correct option? This is something that we have discussed so far, like at least twice until now. So transfer to spouse will always be at no gain, no loss. So this is definitely a right answer. Let's highlight this. Next, private residence relief would not have been available in relation to Jane's gain on disposal of the house. Is that applicable? No, because she was also living in that house because they were married and she was also living in that house. It is available to her as well. So this is a wrong option. Eliminated. You're done with two. Next, the amount of capital gains tax that would have been saved is 3902, or the amount of capital gains tax that would have been saved is 976. Now, how much is the gain that we've calculated earlier, guys? Can anyone tell me the answer to that gain that we've calculated? So that would be nothing but anyone can help me with the gain over this, the capital gain that would have been taxed normally. How much would be the chargeable gain that arises from the property? Is that the chargeable gain or is that the relief that is available? Okay. Chargeable gain is 6 on 7, 100. Now, what is happening? You will transfer it to, you will transfer half of the property, you will transfer half of the property to Jane, correct? So because of that transfer, what will happen? Now she will have half of the gain that will be taxed at that. Is that correct? So because of that, now what will happen? So instead of that, what will happen? She's being charged it. She has already made chargeable gain of 3,000 pounds. Because she has already made a chargeable gain of 3,000, do we get AEA reduction? Is it available? Annual exempt amount of 3,000. Because she has already made chargeable gains of 3,000, this 3,000 will be deducted from that. Is that correct? So AEA available, is some AEA available on that? Yes, no? AEA is not available. Is not available. Because the AEA was used on other residential AEA would have on 3,000 on other residential properties. That means residential property will always be given the first priority when deducting annual exemption amounts. So always remember this point because it is on other residential properties only AEA would have been used up on this. And now Jane had a taxable income of 21,440. So because of this, what will happen? out of 37,700, 21,440 is already having taxable income. So the remaining part of it, not sure why my calculator is not working. Is my calculator visible to you guys? For some reason, I can't see it. Yeah. So how much do you calculate it? For some reason, it is not showing up, guys. So it will be 37,700 minus 21,440 will be taxed at what rate? Here they're only asking about the tax savings that are possible. So usually it would be taxed at 24%. But because because she's a basic rate taxpayer, it will be taxed at 18%. So the gain would be into 24 minus 18%. So it will be 37,700 minus 21,440 into 6%. Can someone do the calculation of this, please? Because my calculator is not showing up for some reason. Guys, am I audible? Am I audible, guys? Can you hear me? Can you guys confirm if I'm audible or not? Because I think there's some issue that is coming up over here. All right. So yes, okay. So now it is 976. You've calculated that. So this is what the tax that would have been saved. So because of that, these two will be a right answers. Is this clear? Any doubts until here? Are you able to understand now? Always when they ask for tax saved, it will always when they ask for tax savings, it will always be the difference between what is the tax rate at which it is supposed to be paid minus what is the tax rate at which you are paying right now. And that is how you will be calculating your tax gains. Tax savings is equal to tax rate at which it was supposed to be paid minus the tax rate at which it will be paid. Because other than the difference of 24%, 18% for this much amount, the rest all will be taxed the same way for both either Jane or William. So the only advantage is because of this difference that you're able to pay it at 18%. All right, so for that only you will be computing the gains. Clear? Let's move on to the next question then. What is the chargeable gain arising on the disposal of warehouse by Luke in December 24, assuming all available reliefs are claimed? So guys, let's see. Luke has sold, in the disposal of warehouse. So first, Luke has sold a factory for 235.74 and then a gain and realized a gain of 31,083. Okay. Now what is happening? In May 2014, he bought a warehouse for 231,211 and then sold the warehouse in December 24 for 270,213. Both the buildings were used for the purpose of Luke's sole trader business. So here, what can be understood? Claiming all the reliefs available. So a factory has been sold out and a warehouse has been purchased. So what is the relief that what is the first relief that comes into your mind when you think of this point? Rollover relief, yes. So your rollover relief is the correct part of it. So in rollover relief, the calculation should be like what you have just mentioned, Avantika. So Yes. So the rollover relief, because of that, what will happen now? The cost will be 231, 211 minus 31083. This will be your cost. And from that, 270, 213 minus this will be your chargeable gain that will be arising. And that is what they are asking. So clear with this? Any doubts on this point so far? 70085. Yes, that is your right answer. You didn't understand this point? Do you want me to explain it again, Milton? Oh, all right. So with this, we come to the end of the second question of section B as well. Let's quickly move on to the third question. VAT. Okay, so here we can see the VAT question has come up. On 1st August 2022, Kilimanjaro Limited registered for value-added tax. Annual turnover is always in excess of 150,000. The most recent VAT returns have been submitted as follows. All previous returns were submitted on time. Now here, for the quarter ended 31st March 2024, the VAT paid was VAT refunded. So here we're getting a refund in the month of 31st March, year March 31st, and so it was submitted 29 days late. Okay. Next, 30th June, it is 4485, it is submitted on time. 30th September 21/6/20, it is submitted 10 days late. So guys, I'm very sure because of this question, because they're asking about the filing and submission, this question will entirely be, or mostly, it will mostly be for your self-assessment only. So you should be very careful and ensure that you remember all the points that are relating to self-assessment. Where I can at least see 3 questions that can come out of self-assessment only. So almost, how much is it? So we have seen calculated 8 marks earlier, and this is another 6 marks. So 14 marks is coming out of your self-assessment only. All right. So ensure that you're preparing well and all confident with all the points relating to filing, payment dates, penalties, and what is compliance check, what are the dates, how many years are the records to be retained for, what are the threshold when it is VAT, what are the thresholds that a person should use to enter into an annual accounting scheme or should exit out of the annual accounting scheme. It is important to remember all of these. All right. You with me so far? Okay. Now, on 1st August 2022, so here, order of goods. Kilimanjaro received an order for goods on 20th October 2024. The goods were delivered to the customer on 28th December 2024. And Kilimanjaro Limited sent an invoice on 15th January 2025, which the customer paid on 5th February 2025. Okay, there are a lot of dates to remember. So probably this will be asking about the tax point of the question. So usually if you see the points that are being asked, you will be able to identify what would be the possible question out of it. Okay, that is something that will also help you understand and ensure that you're thorough with all the concepts. You're able to look at the question and able to identify what is something that they'll be asking you about. Right, it will be the basic tax point. But let's see what the question is later. Write-off irrecoverable debts. On 31st March 2025, Kilimanjaro Limited wrote off 2 recoverable debts in its VAT account. The first, 800, was due for payment on 1st June 2024, and despite being chased, still has not been paid. The second amount was for 1,000, relates to a company that Kilimanjaro Limited has been recently informed has gone into liquidation. The debt was due for payment on 1st December 2024. Okay. And next, during May 2025, Kilimanjaro Limited discovered that number of errors had been made in completing its VAT return for the quarter ended 31st March 2025. Okay. And as a result of these errors, the company will make an additional payment to the payment of VAT to HMRC. Okay. These are the points that have been mentioned to us. Now let's take a look at the questions. What penalties will Kilimanjaro Limited be liable for the late payment on late 31st March 2025 VAT return? So here we're talking about the 31st March 2025 VAT return. So because of before that, how many times were they late? They were late in the month of 31st March 2024 and again late in 30th September 2024. The third time is happening on 31st March 2024. So that means this is the third time that they're filing a late penalty. They're filing their returns late. That means every late payment, every late filing will give you a penalty point. Will give you one penalty point. So since it is a third penalty, what will be the penalty points over here? We can directly identify. It will either be a third payment and no penalty, or a third penalty point and a £200 penalty. Which one will be considered? 31st March, there is a refund, so there will be no payment. Absolutely right. No penalty is our answer. All right, this is how you solve your question. Clear? Let's move on to the next one. Click on the relevant boxes below to identify the late payment penalties that will arise on the 31st March 2024 and 30th September 2024 VAT returns. Guys, in the previous question, one more thing that you should remember is penalty payments will only arise after you exceed your 4 penalty points. Before that also, there will be no penalty that will arise, that penalty payment that will arise. All right, you should keep this point in mind. All right, clear? Yes. Now click on the relevant boxes to identify the late payment penalties that we are talking about earlier. Was asked about filing penalty because you were late to file the VAT return. Okay. Now they're asking about the payment penalties that will be late. Click on the relevant boxes below to identify payment penalties that will arise on 31st March 2024 and 30th September 2024 VAT returns. 31st March, will there be any penalty? Payment penalty, not filing penalty. Why? Because there is a refund that you will be getting. Because of that, there will be no penalty that will be arise. Correct. Because it is claimable. So that is the answer for that. Now coming to 30th September 2024, will there be any penalty that arises? So 30th September, you were late by 10 days. So will there be any late payment penalty that will arise? No. That is right. Now let's assume they were late by 16 days. What will be the penalty that will be payable? That is relating to filing, Malcolm. That is not relating to the late payment. Here they are asking they will always pays any VAT that is due at the same time that the related return is submitted. So here there are two things that you should remember. One is filing, you will be getting your penalty points, 1 penalty points, 2 and 3 and 4, and after that a penalty arises for late filing. But for late payment, you will have a penalty that will arise. Okay. And for that, the values are, if it is less than 15 days, it is always 0. Always remember that 16 to 30 days would be 2%. Is this point clear? Any doubts until this point? Yes. So because of that, both these answers will be 0. All right. Now let's move to the next question. This information, I think, is there in the tax table. If I'm not wrong, the rates of the deduction are there in the tax table. Guys, for some reason, none of my note boxes or anything is loading. I'm not sure why. Like this page is loading, but again, my tax tables and my calculator are also not loading. I don't know what has happened. Some glitch in the matrix, probably. Yes. All right. Now let's move on to the okay. Yeah, we have come here. What is the tax point for the order of goods for VAT purposes? Tax point. So there are two types of tax points. What are they? What are the two types of tax points, guys? All right, that is right. But what are the two different types of tax points? I want to ask you guys this question. Type of tax points. One is basic tax point and the other is ATP, actual tax point. Correct. Now, so here we will be looking at the goods were received. Order was received on September 24th, October 20th, 2024. Is this relevant to our tax point when the order was received? Is this point relevant to us? It is not. Because here we'll be discussing only about the delivery date of the goods. That is when a VAT liability can be recognized. So here, the goods were delivered to the customer on 28th December 2024. So that will become your basic tax point. So your basic tax point will now be 28th December 2024. And here, that is something that we'll have to highlight. So it will obviously be basic tax point if the actual tax point conditions are not being satisfied, correct? Yes, with me so far? Yes. So next, so what for that to be, for actual tax point to become the date, what should happen? An invoice is to be issued within 14 days. But what is happening? The invoice was sent on 15 January 2025, which is not within 14 days. So directly, you do not have to look at any further questions. Directly choose the option 20th December 2024. All right. And that is how you solve your question. Clear, guys? Able. The rule is 14 days for after the, after the goods have been delivered, it is 14 days. But before the goods have been delivered, it is 30 days. If an invoice has been issued 30 days before the goods have been delivered, then that will become your actual tax point. Yes. All right, let's move on to the next question. How much input VAT was Kilimanjaro able to recover in respect of irrecoverable debts in its VAT return for the quarter to 31st March 2025? So here there have been two recoverable debts. One is relating to 800 pounds and the other is relating to the 1,000 pounds. So 800 pounds had due, the payment was due on 1st January 2024 and other is 1st December. So when can any VAT be recoverable? When can an irrecoverable debt, VAT debt be written off for VAT purposes? When it should be when it should be exceeding 6 months. That is 6 months has crossed from the due date. And that has not been the case because 1st December only and we're still at 31st March 2025. So for that reason, the second VAT, you will not be able to recover the irrecoverable debts. So here it says 800 is a VAT exclusive price. Now, how much input VAT can be reclaimed on that? Yes, 800 into 28% will be your 133. That is exactly what you should be writing. And that will be a part of your input VAT calculation instead of always remember, though it is a sale and it has been recovered, it will not be as coming in as a deduction from your output VAT. Deduction, it should instead be shown as a part of your input VAT when you're calculating. So you always know this point, right? It will always be output VAT minus input VAT will be your VAT liability. A VAT on irrecoverable debt will be added to input VAT. That is all you should remember because sometimes they might ask you this question. It might be a tricky question like they'll ask you how do you account for irrecoverable debt. So they say your input VAT is 500, VAT input VAT is 500 and the output VAT is VAT inclusive of debt is inclusive of irrecoverable debt is 800. Now what do you do? And that, so let's assume the answer is 133 over here. That 133 should be added to this. That's all you should do because it's anyway part of this. The effect of it will be nullified. That is what is the effect that will happen because of that. Is that clear? And yes, with this, we come to the last question of section B as well. Which two of the following statements are correct regarding errors which have been made? Now let's take a look at the errors. The errors have been made, and as a result, these errors will make an additional payment to HMRC. Okay. If the net errors are less than either 10,000 or 1% of the annual turnover up to 60,000, the corrections may be made in the next VAT return. This is correct until here. Like until here, everything is right. But after this, because of this one value, this will become wrong. It will be 50,000. 50,000 is the limit. All right. Clear with me? With me so far? Yes. So because of this wrong value of 60,000, it goes wrong. Next, errors exceeding the de minimis limit must be separately notified to HMRC as soon as practicable. Yes, this is the right one, obviously, because straight up right. Next, the maximum additional penalty that can result as a result of an error is 100% of the VAT loss due to error. Okay, so it is right only, but also let's take a look at the other option to identify why this is definitely right. Company has not attempted to conceal the error and has apparently made a voluntary unprompted disclosure. The penalty will not exceed 20% of the loss tax and may be waived together. Again, this is completely right until here. And again, over here, this 20% is where the mistake has happened. It is 30% and not 20%. And if you remember, points like this is all that you need in order to ensure that you're very strong with your theory aspect of it. All right, so options will be B and C. And with this, we come to an end of section B as well, guys. Any doubts until this point? Was the discussion helpful so far? Like all these points will simply always remember, because I wanted to primarily discuss section A and section B in this call, because section A and section B are yes or no, hi or no. You'll either get full marks or nil marks. So for that, if you're able to identify points like these, or how to process, how to ensure that you write your answer, what is the format that you should follow, using your rough sheets, how do you use, what should you write in your rough sheet? Like your first question that we have seen, you had non-savings income, savings income, and then dividend income. So write non-savings, then dividend, savings, then dividend. Then remove your personal allowance accordingly. Then do your tax calculations. So have it in a very structured format instead of adding everything at one place and making it clumsy. This way, it will really help you ensure that you're able to get good marks and you have a clear thought of, your clear flow of thought, which will help you answering questions in a correct manner. And for theory questions, always elimination theory works the best. Like you should be able to identify what is right. If you're unable to identify what is right, at least try to know what is wrong. That's it. You're good to go on your questions. So with this question included, we are almost having 16 marks of theory only. Great. That is so good to hear, Welcome. So now we are good to go. So section C, do you guys want me to discuss that? Because I think I have also corrected the papers. But section C, I'll try. So section C will keep it short. We'll try to identify what are the points that you should keep in mind. And that will really help you understand how do you do it, okay? And anyone who has not attempted section C so far, I would request you all to go ahead, attempt the test and send the paper to me so I can take a look at it first to know how you're presenting your answers. Second, to understand if you are making any small calculation mistakes so that they can be corrected within the next 2-3 days. Next 2-3 days is where very important, guys. Ensure you stick to the basics. Go revise every day. Solve at least 2 to 3 questions of corporation tax, 2 to 3 questions of income tax of Section C. Then any questions that you're finding it difficult, like any type of questions, like having questions where you have to choose one or multiple options or something like that. Try to solve as many questions of those as possible, and do not try to learn anything new at this point, because you will not be able to remember those, or you might be able to remember those and forget the main things that you have studied for a long time. So it is important that you stick to whatever you have studied until now, and revise and revise and revise these 3 days. That is all I want you guys to do. Any doubt at any point, you can always ping me. As you know, I will always be at least like maximum. I try to ensure that all your doubts are resolved as immediately as possible. But even if not, at least within the next 3-4 hours, I'll ensure that all the doubts are resolved. All right. Yes. So now let's see the important factors that you should be able to be remembering in this question, because the other part of the question is something that you'll be able to do. Let's see the important points that you might be missing out on. Students might miss out on. And here, when I say you, it is never you guys. It is generically the papers that I've seen while correcting and what are the mistakes that I've seen. It is never I'm talking about just the both of you guys. All right. Next, on 6th April 24, John will purchase a residential freehold property which he will let out. Okay. However, John is unsure whether to purchase a property personally or via the limited company. The limited company would be incorporated for sole purpose of purchasing and letting out the property, and John would hold all of the shares in the company. Okay. The property will be let throughout the year in a monthly rent of 3,600. So here, 3,600 is your rent. The purchase of the property will be partly financed with a repayment mortgage. Mortgage interest of 15,000 will be paid during the tax year. This is the most important point to remember. Like very important. I'll tell you why when we go on to the later part of it. The other expenditure on the property was 5,000. All of this will be allowable. So it has been directly given as allowable, so it can be reduced. Not necessary. Like John will also have an employment income of 70,650 for the tax year 24-25. If property is purchased by a limited company, then the corporation tax will be 4294. So here they have already mentioned it. When you're calculating it under company, when you register it and then as a company, you will have a tax of 4294. It has been mentioned to you. Okay. John will withdraw dividends of 7,000 from the company, totaling 7,000 during the year. Okay. When it is registered. So these are the conditions when the company is registered. Otherwise, these are the conditions on which you will have to work your answers on. Okay. When employed. When business is registered. Is registered. First, employment income. Always consider. Again, here you will have what are the different types of income. If you are employed, you only have expenditure and other employment income and property income. So it will only be non-savings income. But when the business is registered, what will happen? We are talking about the individual after the business is registered. He will have employment income that will continue to exist. And he will also have dividend income because he's getting dividends from this, will be able to withdraw dividend. So dividend income will also exist. First, do this classification. Good to go on this? Doubts so far? Any doubts with me so far? Yes, mortgage is for residential property. Yes, mortgage is for residential property. And because of that, it will act as a tax reducer. It will not be deductible from your property income. So here what you do, your employment income is 70,650. 20,650, correct with me here? Next, your property income. Always when you have multiple calculations like additions and subtractions, show it as a part of working note. If you show things as working notes, it will be very clear to the present evaluator and the chances of you getting better marks is higher. All right. Always remember this point. Do not just show property income. add mortgage, add rent, less allowable expenditure, mortgage zero. You should not do it that way. Always show it as a separate working. Now here what we can do is show this as a working. Working one, property income. So property income, what will happen? Rent is equal to 3,600 into 12. You show your calculation, you get the answer. Okay, next. Okay, super good. I have been. Okay. Less allowable expenses. Less allowable expense. You get how much is your allowable expenses? 5,600. Mortgage. You should show it as zero here. If you show it as zero here, you will be getting 0.5 for this point. Okay, we will get relief. Okay, what is your question? As this is for 12 full year, 12 months, it can come in less than 12 months. Yeah, obviously. So individual, when you are individual, always remember it can come in any format. If it is for less than 12 months, if you had a property, like you purchased it midway, you would not purchase it on 6th April, but you have purchased it on 10th of June or something like that. So it should be computed proratedly. All right? Because for individuals, to which method do we follow? Cash basis or accrual basis? Property income, what is the default method of computation for individuals? Cash or accrual? Yes, it is cash basis. So because of that, your property income, you add, you get the sum over here is equal to sum. And always, as I've told in my other videos, if you guys have looked at the videos as well, I've always told it, show it in the form of formulas is equal to reference it from here, because that way the mistakes of transposing, like you've seen it as 37,600. 37,600. Okay, what is the question now? Sorry, I missed out. Can be losses brought forward too then? So when losses are brought forward, how do you relieve your trading? How do you relieve your losses? That is a question for you, Avantika, because we are left with the last 3 days. So how do we relieve our losses? Correct, exactly. That's exactly what we should be doing. First, any property income, any losses are there, they should be set off against the property income. Property income. That is what you will be doing. Got it? And here you calculate, then you deduct your NIs, you deduct your personal allowance that will be reduced. You do everything that is to be done. Everything is correct. Now, when you calculate your tax, what will happen? First, 37,700 at into 20%. Do it right. Next, whatever comes, you do it right. Into 40%. You do it right. But when there is a mortgage interest, it will act as a tax reducer. So always remember that point. If you forget that point, that is when you will be losing your marks out. So tax reducer is equal to minus 15,000 into 20%. It should be done on your tax computation, not as a deduction from your total taxable income. Got it? With me so far? Yes, it will be relief after the tax liability. Total tax liability you calculate, whatever you get. From that, you deduct 15,000 into at base rate, always at 20%. Remember this point. Clear? This is what you should be doing. Yes. Now, when you come to when a business is registered, what will happen? The employment income will be as it is. But do we have any property income that should be included if a business is registered? No, because that will be a part of your company. So because of that, that will not be there. And your dividend income, you will get dividends from the company totaling 7,000. You will have a dividend income. Now, what do you do? Calculate tax on both of these minus 12,570 dividend income appropriate rates You get all of these. XYZ is your tax plus the corporation tax that you have paid over here, 4294. Like I have solved, I have, reviewed many answer scripts in the last few days. And this is a major mistake that I've seen everyone, most of them do it, is that they miss out on taking this into consideration when they ask if there will be an overall tax saving or not. If a company is registered, it is the income tax payable as an individual plus corporation tax payable in comparison to income tax, that is the income tax liability that arises as a result of self-employed without registering it as a business. Always remember this point. This is the most important thing. You should be deducting 4294. You should be adding 4294 to your total tax liability as well to compare it. All right? Clear? Yes, and with that, you'll be able to get your 9 marks straight up. Ensure your calculations are right. Whenever you're doing any additions or subtractions, whenever there is any adjustments that to be made, show it as a working. Point two to remember. Point three to remember. Always do it. Do a referencing. Like if you have an answer here and you want to reference it here, so you can, if you add is equal to and select the cell where the answer is, your answer will it will exactly show the correct answer over there. And it will also help the evaluator know, okay, where has the calculation been made at? All right, got it with me so far? So Avantika, for that, there's nothing that we can do. Always remember, stick to the basics. What will happen if it is a self-employed? What will happen if it is a company, if it is, having NICs. NICs, what will happen? Who will be calculating class one and class one NICs? Will it be part of employment income? So will you get class four if it has been registered? Those are the pointers that you should remember, and it will really help you. Stick to the basics. Like, these are all there. Okay, if income tax is there, how will it affect us? If, corporation tax, how will it have an impact on the competition? Have that strict distinction between both of them. You will be able to solve your examination questions. Trust me on that. All right. Solve, solve, solve. These are the only things that I'll tell you. Solve as many questions as possible. And any doubts, if you're not able to understand how the computation is being done, we can discuss those at any point of time. Always here to help you guys out. All right. Until Tuesday, what time are you writing your exam? Is it in the morning slot or in the afternoon slot? Whichever slot anyone is writing it at. Until then, you will be getting. Yeah, okay. What about you, Malcolm? Afternoon. Okay. Until then. So Tuesday is something that I would not want you guys to learn anything new at all. Like, do not touch anything that is new for that day. It should only be whatever you have revised. You can go through those again, but not anything new at all. All right. With that, let's move on. Can you hear me though? Are you able to hear me clearly now? Am I clear now? All right. I think there is some internet disturbance. Yes. So what is that one difference between, capital gains for companies and individuals? It is a very straightforward, simple difference between the both of them. And that is no AEA. Annual exemption is not available. That is all you should be writing. Obviously, you should not write it as this. You should write the difference between corporate capital gains for individuals and if sold disposed by companies is that there will be no AEA available when the disposal is made by a corporation of 3,000. Okay, you should write that. That is all you should be writing. Got it? Is everything clear until here? Okay. Go to the next question. This is again the most straightforward question you can ever get. Calculate Gregor's income tax liability for the tax year. Gregor is a finance director. So first remuneration, you should be taking it. So George paid 150 a month to selected charities under payroll scheme. Is it a deductible expense? Yes, no? Yes, it should be deductible. So most of the students have wrote it as zero. Guys, here you are actually computing the entire tax, entire income tax of that person for the taxable total income of that person. So for that reason, you should be deducting that. Okay? Deduct. Yes. Used private car during the period he drove 15,000 miles in performance of duties, for which he has paid an allowance of. We're calculating tax adjustments. Then if it says that it has already been included, then you mark it as zero. Got it? Yes. Mark it as zero. That is all. And for marking zeros, you will be having 0.5 marks. Probably once we take a quick look at the next two questions, I'll show you the marking scheme as well, so you'll be able to understand how the marking has been done. George used his private car for business purposes, 15,000 miles. Here again, guys, only for NICs miles it will be 0.45. But for income tax computation, 10,000 miles only 0.45. Over 10,000 it will be 0.25. Always remember this point. All right. Very important. Do not ever get confused between the both of them. Okay. Then for NIC computation, like class 1 NIC computation, always the mileage will always be calculated at 0.45 pence across. But for individuals, for first 10,000 miles, it is 45 pence. Over 10,000 miles, it will be 0.25. So if you have traveled for a total of 12,000 miles, then first 10,000 into 0.45 plus 2,000 into 0.25 is how you should do your calculation. Okay? Clear? Yes. Next. This is where I've seen again most of the students go wrong. In this, you can see Quick PLC provided George with a diesel company car with a list price of 43,000. The car was purchased by company at a discounted price of 38,000. Discounted price, irrelevant to us. Always when we are taking the car price, it should always be the list price. Always never take the discounted price into consideration. Most important, first point to remember. All right. Next point to remember is George contributed 6,800. Over here, any contributions by an individual for a car benefit is restricted to 5,000. So they always, if it is less than 5,000, okay, but the maximum that they can contribute is only 5,000 pounds. So even though he is restricted, he has contributed 6,800, the price taxable benefit will be charged on. Benefit will arise on 43,000 minus 5,000. Most important point to remember. Okay, 5,000 limit and taking the list price. Other than this, the calculation part, everyone has been doing it right. Like emission rate, you use it to calculate it over 16%. And what is the maximum threshold? 37%. Accurate. Very good. Again, From 1st Jan, it's provided with a laptop costing 2,500 primarily for business use, was replaced on 1st January with a new equipment costing. Purchase the first equipment for £60 when its market value was 250. Do you remember what you studied earlier? It was purchased at its market value 250. Is this value 250 and the gain is £190, correct? Because the value is £60. Over here, you should read over here. The important point you should remember, primarily for business use. It has been mentioned. So now here, what is happening? You're getting the asset only because I get a discount. So the asset which was £250, you are able to get it only for £60 now. So that is the only thing that you should be considering. So the gain will be 250 minus 60. Taxable benefit will be 250 minus 60. Okay. Yes. And again, with this, everyone has almost done it right. Gross rateable value of 10,150. And because what is the value of the property purchased for 100,000 and was valued at 230,000. That means there is an excess over 75,000. So an additional benefit arises. That is only one thing that you should remember. If the value is more than 175,000, then an excess benefit arises. Clear? So it will be 10,150 plus, will it be 100,000 minus 75,000 or 230,000 minus 75,000? $230,000. Absolutely right. Okay, now into which he paid, now next to the member of pension scheme, into which he paid contributions. So contributions deductible, not deductible? Deductible. Now, what about the contributions paid on his behalf? Or behalf, employer paid the contributions. Is it a taxable benefit or is it an exempt benefit? Exempt benefit. That's it. That is all. So if it's an exempt benefit, you mark it 0. You mark it 0, you get your 0.5 marks right there. All right, clear? Yes. And once you do all of that, whatever you get, you start computing your income tax liability, minus personal allowance and all of that. All right, clear? Let's move on to the next question. Here they are asking tax adjusted trading loss for the year ended 31st March. And guys, you can see if they ask you to start your calculations from somewhere, always remember to use that figure as your starting point. So here they have said operating profit is this. So if they say this is your starting point, you should add back all the non-cash expenses that have been claimed until here. Until here, what have been taken should be added back. But if any expenses that are related to the ones, any expenses are related, but which have not been included in this computation, they should be deducted. All right. Did you understand this point? Yes. So we are starting off with 130,142. So from this depreciation, should we take it? Allowed it, disallowed? Yeah, that is understandable. But those one simple sign change of plus to minus, minus to plus, the entire answer goes for a toss. So here, Avantika, first question that they're asking is, they're asking us to start calculating the trade tax adjusted trading profit only. Here we're calculating the taxable trading profit. We did not go to any gains part. Is also included in that forward. Okay, so if you're telling that if there are any gains that have been included as a part, like property income and all have been included in computing your operating profit, you're asking me if you have to deduct them. Correct? Yeah. So any gains that have been included should be deducted. Yes. And any property income should also be deducted because it should be shown separately. Clear? Yes. So depreciation should be added back, correct? Because it's a non-cash expense. Straight up, you do not have to think of anything from that. Next, whenever they say, beside that, if they mention points like note, always take a look at these notes because there might be something that is relevant to us over there. Here they say leasing costs are 6,300. So usually, if the leasing is relating to the cars, then you have cars with less than 50 grams, then the leasing costs are completely allowed. But here they say leasing costs are in respect of a car with CO2 emissions of 78 grams per kilometer. And because of that, 15% is disallowed. So that 15% should be added back. Because it is deducted, it should be added back. Understood? With me here until here? Yes. So we have completed first point. We have completed the first part of it. We have completed the leasing cost part of it. Now let's come to the entertainment expenses. The total entertainment expenses were 15,000. Of these, entertainment of customers during client appreciation week. Allowed, not allowed? Not allowed. Here, irrespective of foreign customer, UK customer, doesn't matter for corporation tax and self-employed employment, entertainment of customers is disallowed expenditure. So should be added back. This is 6,400 is a part of 15,000 that was deducted. So should be added back. Next, staff Christmas party of 3,600. Allowed, disallowed? Staff. It is completely allowed. Because it is allowed, you should show it with 0. Always remember, show it with 0, you will be getting your marks. Otherwise, no, you won't. You will lose out on that 0.5. Though your end answer might be right, because you have not shown it as 0, you will be losing out on a 0.5 that you will be getting over here. Got it? Yes. Next, gifts to customers, books and pens with Retreat logo limited, given to 125 customers. So the total gift value, so every gift is not allowed. What are the exemptions for the gifts that can be given to customers? The value should be less than 50 pounds. It should not be food, alcohol, or tobacco. Correct? And it should have a conspicuous marketing scheme. But here we can see that, conspicuous logo. Logo is there, satisfied. Books and pens, satisfied. Next, but 5,000 is the value for 125 customers. Is it below our 50-pound threshold or not is something that we should check. So 125. Since it is 40 pounds, that is why it is allowed and you should show it as 0. Got it? Next, donations of 13,000 have been deducted. Next, it says political donations. Political donations always allowed or disallowed? Always disallowed. So they should be added back. QCDs? Allowed, disallowed? QCDs are disallowed from your taxable tax adjusted trading profit computation because they will be deducted from your total taxable profits. Got it? That is an important point to remember. Like everyone, political donations, they do add them back, or sometimes called QCDs, they add them back. But always remember, political donations, irrespective of it, always disallowed. Okay, so we have completed until entertainment expenses, donations. Now let's move on to the last part of this, other expenses. Legal fees relating to purchase of a 10-year lease of a building. Always remember, purchase of a 10-year lease of a building is considered as a capital expense. Okay, that is why it will be disallowed. But if you see renewal of any leases, renewal of leases are considered as a revenue expenditure and they will be an allowable expense. So renewal should be 0 and the purchases of purchasing the lease of the building should be added back. That is how we do it. Is this clear? Yes. Next, Retreat acquired a leasehold office on 1st April 24 and paid a premium of 30,000 for a 10-year lease. The premium has not yet been accounted for. Is the premium taxable? Allowed? Yeah, allowed. But how do we compute the premium? What is the premium computation formula for the premium computation? It will be is equal to 30,000 and is equal to 30,000. How do you calculate that, guys? Into 2% into 9. Correct? Am I right? 10 minus 1 or 9. Correct? That's how we do it. So 5,400 is equal to. Can you just show me the question where you have faced that, Malcolm? So probably we can take a look at that next later. You can send it over to me on in the group or something and we can discuss it over there. Yeah, sure. So it is 24,600. Because it is 24,600, it is applicable for a period of 10 years. It's applicable for a period of 10 years. So in the current year, how much do we calculate? Premium calculation is always the same Avantika. There's no changes in the calculation. It is the formula is the same. Yes. So because 24,600 is for 10 years, how much should be accounted in this year? It should be 24,600 divided by 10. No, even there we'll be deducting that only. No, we will not be adding it there as well. That will be given as a part of the tax table also, if I'm not wrong. Guys, and let me tell you, I think if you guys have seen my most videos, I have told you this is the most important table that you will have to look at. Like it is everything that you do not have to remember what are the ties. You will have to remember what the ties are, like what are the ties that you should satisfy. But what are the number of ties that you should not necessary to remember? You will have it here. Child benefit, income tax charge, car benefit, everything will be available to you. You just have to know how to use it. So whenever you're preparing, my sincere suggestion would be always take a look, keep taking a take a look at the tax tables when you're doing your computation so that you will get habituated to looking at it during the examination and reduce the errors that are possible because of small calculation mistakes, because of wrong percentages being used or anything like that. Okay. Next, here it says retrieved, remitted, received dividends during the following year. Are any dividends related to us? For corporation tax, dividends are always exempted. This is a most important point to remember. Some of the students try to add them, but never add them at all. Dividends are always exempted. Next, we have chargeable gain. This was 3% for 110,680. The shareholding was purchased for 80,324. Indexation was 0.40. This I'll show you the calculation, guys, because some of you have made mistakes here. Now gain receivable is cash proceeds are 110,680. Okay. Less cost is equal to how much is it? 80,324. Unindexed gain. Unindexed gain would be is equal to this minus this. Okay. Now less indexation allowance. Indexation is something that is applicable only for companies. Indexation allowance, guys, always for shares, and shares is something that I want every one of you to look at using indexation and without indexation, because most of the students go wrong in the share capital gains that arise on shares because of not considering it as a share pool or anything like that. All right. Is that clear? Equal to unindexed gain cost into 0.401 is equal to the unindexed gain minus this. Always remember, so your unindexed gain is 30,356. but your indexation allowance is greater than your unindexed gain. That means your chargeable gains that you should include will be zero. Because of indexation, the gains can never go convert from gains to losses. The least it can go to is only zero. All right, always important to remember this point. If you want, write it down somewhere, but always mention a point. Indexation cannot create a loss at any point of time. Okay, very important point to remember, guys. Do not miss out on this point at all. All right. So now this is anyway not related to the tax adjusted trading profits. Okay, because this is relating to the next question where they ask you to compute your taxable total profits. Now your taxable total profits would be income, tax adjusted trading profits, plus if they are having any profit income, that. If you are having any profit income, it will be that. And if you're having any, because chargeable gains are zero anyway, from that totally you will be deducting your QCTs. All right. Here again, there's one more thing I think we have missed out on discussing the capital allowances. Purchase of second-hand equipment, 30,000. Okay. Disposal super reduction was claimed. If super deduction was claimed, as I've told you earlier as well, super deduction has been claimed. Whatever proceeds are received will directly be taken as a tax charge deducted from your total allowances. Always, this is a straight up point to remember. And if the integral features of and if the integral features are disposed, the 50% FIA was claimed on them. Then because of that, what will happen? This 7,000 will also become a tax charge, but it should be deducted from your special rate pool and it should be deducted from your total allowances column. Am I correct? Yes. These are the only points that you should be remembering. That's it. And with this, we come to the end of all the questions. Okay. So let me show you something, guys. I've opened them. So you can see here, like employer. In this previous question, we can see that employer, whatever the employer has provided, is an exempt benefit and it is provided with zero. Now, if you go down to the marking scheme, you can see employer pension contribution. You are getting 1 mark just for writing zero. Can you see that? That's how important marking zeros is. Otherwise, you'll be everything that you've done, your calculations, everything, entirety is right. But because you have not marked it zero, you're losing out on 1 mark. So with that, we come to an end. I think we have discussed everything. Do you guys have any issues or doubts so far? Was the discussion helpful? The only thing that I wanted to discuss off, because I think it is wrongly conveyed earlier, is that class 1 NICs, earlier I told that it will be part of your payment on account, but class 1 NICs will only be deducted as a part of your payee and not of class 1 NICs, as not part of your self-assessment or payment on account. Okay, is that clear? Yes, that's the only thing that I wanted to make it clear. Other than that, with this, we have discussed everything. Hope you guys have liked the session and it was informative enough to understand what are the things you should remember and you will practice sufficiently according to this. All the best, guys. Any doubts at any point of time, you can always reach out to me and I will be able to help you guys out.